The United States and China have been sparring lately over trade disagreements. The heart of the question is, what's more important, free trade or fair trade? We're going to dissect that issue in this video brief, looking at three different things. First, we'll start with a case study that shows why comparative advantage is so important. Number two, we're going to look at trade deficits and why they're not actually a bad thing. Third, we're going to look at trade policy risk from a portfolio management perspective. Happen to recognize these two guys? In 1976, they started the biggest company in the world, Apple Computer, out of a garage. That's Steve Jobs and Steve Wozniak. Alone, neither one of these two Steves would have been able to build Apple Computer to what it is today. Steve Wozniak was a great genius when it came to computer programming. Steve Jobs didn't know how to build a computer, but Steve Jobs could sell, and in that way, they combined their talents and created something very special. Economics, whether it's in a business or in an economy, is all about trade-offs. Comparative advantage is when somebody takes the thing that they're uniquely best at and trades it for something else that somebody else can offer them that they wouldn't be otherwise able to produce themselves. This creates a bigger pie for everybody. So the next thing we're going to talk about is why trade deficits aren't really this terrible thing. I mean, a lot of it just comes down to poor word choice. The word deficit, what does it imply? Not enough. In reality, trade deficits and GDP growth are actually connected. And that's really easy to see with this chart. This shows you year-over-year change in GDP, that's the blue line, versus the change year-over-year in trade deficit as a percentage so that you can compare apples to apples. And what you see is there's a direct correlation. When US GDP is rising, the trade deficit widens, and vice versa. That's because when the economy's growing, there's more opportunity for consumption, and that widens the trade gap. The real revelation here is that having a trade deficit is a byproduct of being a wealthy nation. Economies consist of individuals who produce in order to consume. And it's consistently the case that rich areas, whether they be cities or countries, run trade deficits. How come nobody ever worries about the trade deficit for Beverly Hills? I mean, after all, people import everything from fancy cars to clothes, you name it. The reason Beverly Hills can perpetually run a trade deficit is because the money that flows out of the country to buy something like, say, a Bugatti, comes back into the country in the form of foreign direct investment. That's money that goes into government debt, our company's stocks, all kinds of different things. But the point is, everything balances out in the end. So if this stuff makes sense, why are the markets getting rattled over trade debates? What's the risk here from a portfolio management perspective? Here's Ben Stein with a riveting explanation.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? The tariff bill, the Hawley-Smoot Tariff Act, which anyone raised or lowered, raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression.
Okay, so here's what's really going on. President Trump's call for tariffs has stoked fears of the first major trade war since the Great Depression. No one wants to see a repeat of what happened back then. After Smoot-Hawley went into effect in 1930, global trade fell over 60%. Here in the US, unemployment climbed all the way up to 25%. The good news is nobody's proposing today anything close to the tariff rates that we saw in the 1930s. The real fight here is between President Trump and the China tech industry. IP theft has been a controversial issue related to China. However, the Made in China 2025 program has increased R&D spending for Chinese tech companies, and they're catching up on their US counterparts. We'll see what happens, but my guess is cooler heads will prevail in US-China trade relations. President Trump loves a great reality show, and he talks tough when it comes to negotiating. But reality is, both countries benefit from a trade relationship with one another, and that's certainly the message both presidents are receiving from the business community. This week, top economic officials from China head to Washington, D.C. to hold high-level talks with Treasury Secretary Steven Mnuchin. Trade hawk Peter Navarro will not be attending the meetings, which could be a sign of a shift towards a more conciliatory tone for the president. Here's how we model 3 different scenarios, a good, bad, and ugly, in terms of S&P 500 impact and GDP. We think, in all likelihood, we're not going to see a repeat of the 1930s mistake, so you're probably looking at one of the top 2 scenarios. The final point is to not view trade in isolation or in a vacuum. Tariffs tend to make things more expensive, as evidenced by this chart with Canadian lumber, and the key with that is any pressure that comes from this realm only exacerbates already existing pricing pressures as commodities have risen and so have interest rates. Those are the forces that tend to tip over an economic cycle, so manage risk carefully.